an investment advisor and managed money for more than 25 years. My experience tells me that, yes, people want to grow their money, but more important, they want to protect their money. And I want to share the 4 best ways that I've learned that you can use to protect your money. First, understand that nothing is perfect. Don't expect your investments to always go up, or for that matter, don't expect your investments to always beat the market. If you invest, there will be years, sometimes many years, where you'll lose money. And if you follow some of the other rules that I'm just about to share with you, there will be years that you won't keep up with the market. Think about it. If you diversify your assets, which usually is a very good idea, that means that you don't have all your eggs in one basket, which is the S&P 500. And that means your results won't match the S&P 500. Now, if you fail to accept it, if you can't accept that you'll lose money and underperform it at other times, you'll lose money at times and underperform it at other times, you'll end up taking on too much risk and hopping from one system to another, and that's not a good idea. Now, the second way to reduce risk and protect your money is to diversify, as we've said. Don't put all your money in one index like the S&P 500, and don't put all your money in the stock market. Now, by diversifying, you might reduce your results, right? Your returns might be lower. But you also might have a better shot at achieving your long-term financial goals by reducing risk. In other words, the reduced return might still be enough to get you where you want to go financially. So why would you take any more risk than you absolutely have to? It just makes no sense in my way of thinking. Now, the third way to potentially reduce investment risk is to have a market filter. Now, this is what I talk about in the videos where I talk about numbers-based investment strategies. Now, these strategies have the potential to help you sidestep big market drops. They're not foolproof, there's no guarantees, and sometimes they actually cost you more money than they save you. But the idea is, hopefully over the long run, in the big picture, they'll save more than they cost. Now, the fourth way I found that actually can help people avoid risk is to have a financial plan. By having a plan, you can put your investments in perspective. And you can maintain your long-term view. The problem that many investors have is that they take on a short-term view with their long-term money. They ignore the 3 risk reducers I spoke about just a minute ago. And then when the market turns south, they react to the short-term drop rather than maintain their long-term perspective. So that can be really costly, as I said. As I said before, also, Dalbar found that individuals on their own earn half to a third of what their underlying investments earn. And that's because investors on their own hold on to their investments for an average of less than 1 year. Why? Because as we learned earlier, the market can easily crater 14% in any 1 year. That's the average loss. And it's quite normal. But people without a plan usually don't have perspective. And then they react, and they end up paying for it. And it costs them a lot of money, and they jeopardize their financial future. Every investor needs to consider risk. My advice is take the least risk possible in order to achieve your goals. And in my opinion, these 4 ideas can help you do exactly that. Thank you very much. Shoot me an email if you have a question. Like the video. Share it with friends. I look forward to connecting with you.